A global macroeconomic shock rarely begins in a spreadsheet. Instead, it almost always begins at a localized physical choke point. The date is Thursday, March 26, 2026. Global markets are currently reacting to day 27 of the ongoing U.S.-Israel-Iran war. Tehran is drafting a bill to enforce a safe passage fee for all vessels transiting the Strait of Hormuz, effectively turning the world's most critical energy artery into a mandatory maritime toll booth. Millions of barrels of crude rely on this specific corridor. The logistics of moving that volume leave transit vessels subject to localized disruption. This naval blockade threat coincides with severe military escalation. Today, Israel launched wide-scale infrastructure strikes in Isfahan to degrade Iranian missile capabilities. U.S. President Trump has claimed a negotiation breakthrough is imminent. However, institutional capital is pricing in a structural risk premium, unmitigated by diplomatic rhetoric. By drafting a law to extract transit fees, the regional dispute has weaponized global maritime logistics. The conflict is now a mathematical tax applied directly to the global economy. The immediate reaction hits commodity pricing. Brent Crude has cooled from its absolute peak of $120, but it remains anchored at $98.28 per barrel. Looking at this physical infrastructure reveals where the squeeze occurs. Refining these squeezed energy inputs requires massive capital, locking costs at a premium. For Western economies, elevated oil prices guarantee severe margin compression. This forces a prolonged stagflationary environment, where low growth collides with stubbornly high consumer inflation. Ultimately, every single heavy industrial complex, global supply chain, and maritime logistics network absorbs that massive foundational energy cost. $98 oil acts as the foundational variable overriding central bank models. It is the exact catalyst fracturing global equity performance today. In the United States, the S&P 500 sits near 6,680, actively testing the crucial support of its 50-day moving average. The macro trap is straightforward. The war premium in energy anchors domestic inflation, forcing the Federal Reserve to commit to a higher-for-longer interest rate path. This delayed timeline manifests technically. The S&P 500 is forming a head and shoulders pattern, projecting a downward correction towards 6,450. Any attempt to rally is met with institutional supply. There is an impassable ceiling at the 6,780 level, which has consistently rejected price action. This structural fear is quantified by the global VIX. The VIX measures market volatility and the mathematical cost of downside protection. It remains historically elevated at 25.10. U.S. markets are paralyzed, caught between a resilient domestic labor market and the imported inflation shock of the Hormuz Deadlock. In Asia, Japan's Nikkei 225 has reclaimed the 53,000 mark, following a late-week recovery in risk appetite. However, the Bank of Japan is caught in a policy deadlock. They cannot raise interest rates to defend their currency without crashing a domestic economy sensitive to this energy shock. This dual-axis chart compares the mathematical trap. As the yen weakens toward 158.79 to the dollar, the cost of energy imports spikes, crushing domestic purchasing power. Europe faces a similar bind. Germany's DAX index is exhibiting fragile resilience, ending Wednesday at 22,636. The index received a tactical tailwind from China, where industrial production data beat expectations, posting a 6.1% increase to support German export machinery. Yet, this data is a trap. The economic benefits of strong Chinese demand are negated by the structural threat of industrial energy rationing. There is one massive anomaly in the global landscape: the Arab markets. The Saudi Tadawul, or TASI, is holding steady near 11,006. The fiscal mechanics here work in reverse. Brent Crude, priced over $100, acts as a revenue cushion for the kingdom, ensuring robust government spending for energy heavyweights. Looking at this comparison chart, the decoupling is obvious. While Western indices struggle with margin compression, the TASI breaks into a clean, detached bullish trend. The energy supercycle provides a technical floor of support at the 10,800 moving average. The Saudi market now operates as a structural haven for algorithmic capital seeking to survive the stagflation affecting Western indices. When we move from the global macro environment to the microdata of Indian equity markets, the tension fractures the tape. On the surface, there is an illusion of domestic euphoria. Indian cash markets closed for the Ram Navami holiday, following a 1.72% surge, leaving the Nifty 50 at 23,306. But the offshore derivatives market issues a reality check. The Gift Nifty is actively signaling a 130-point gap-down contagion for Friday's open. This bar chart reveals the institutional tug-of-war happening beneath the spot price. We see massive foreign liquidations of 5,518 crore, offset by domestic retail absorption of 5,706 crore. The foreign exodus is driven by a specific failure point: the persistent weakness of the US dollar to Indian rupee exchange rate, currently at 93.96. The spot market's resilience is artificial. Smart money is tracking the currency decay caused by the global oil toll, and they are exiting high-beta assets. Drilling into the granular futures and options data for Friday's opening, the put-call ratio sits at 0.91, with the max pain level gravitating toward 23,200. Max pain is the strike price where the highest number of open options contracts will expire worthless, acting as a magnet for the underlying index. This 3D visualization maps the mathematical barriers priced into the options chain. Call writers have built staggering algorithmic resistance, forming towering peaks at 23,500 and 23,800 to cap any rally. Conversely, the base of support built by put writers at 23,000 is shallow and fragile. This data isolates the most critical technical anomaly on the board, a strictly defined empty bandwidth, known as the Hormuz gap zone, sitting between 23,650 and 23,700. This specific numerical gap acts as the ultimate binary trigger for macro sentiment in the domestic market. Until this gap is filled and sustained on a closing basis, institutional trading desks will structurally default to a sell-on-strength protocol. Surviving this environment requires a rigid defensive rotation. High-beta banking stocks are vulnerable, pressured by both foreign liquidations and rising 10-year government bond yields. Conversely, the IT sector provides a dual hedge. These export-heavy companies benefit directly from the weakened rupee, acting as a shock absorber. The impending maritime toll in the Middle East has now shifted global algorithmic capital into rigid defensive parameters. This physical choke point is now a dominant variable for global markets, weighing on asset prices from New York to Mumbai, regardless of central bank guidance.